Welcome back to the Deep Dive. It is Monday, February 9, 2026. And I've got to say, right out of the gate, if you told me, maybe 5 years ago, that we'd do a whole deep dive just on stablecoins, I probably would have laughed.
Because they were the most boring part of crypto.
Boring is putting it mildly. They were the digital equivalent of a parking lot. Yeah. You park your money there while you wait to buy something exciting.
Like Bitcoin or whatever Dogcoin was going crazy that week.
Exactly. They were just utility. Useful, but not interesting.
Well, that's definitely how it started. But, I mean, looking at the sources we have on the desk today, calling it a parking lot in 2026 is like, it's like calling a skyscraper a pile of bricks. You're missing the whole structure.
That's a perfect way to put it. This isn't a parking lot anymore. We're talking about a global economic engine.
Huh?
As of last month, January 2026, the market is over $310 billion.
A huge number.
And the sources we have, I mean, a massive report from Tether, legal analysis from Jones Day. They paint a picture of something that has just fundamentally changed the plumbing of money.
And that's the mission for this deep dive, right? We're not talking about price. The price is supposed to be boring. $1.
Yeah, if it's not $1, we have a very big problem.
A catastrophic problem. So the mission is to understand how this asset class has quietly become this shadow backbone for global finance. We're going to look at a new law from last summer, the Genius Act,
Right.
and see how it changed the rules and why whole nations are suddenly very, very interested in who holds these digital dollars.
And we've got quite a stack to get through. That Tether Q4 2025 report, the regulatory white paper from Jones Day, a really fascinating academic paper on what they call stablecoin Legos.
We'll definitely get to that.
And some news on the creator economy. But let's start with that big number, the $310 billion gorilla in the room.
The growth has just been relentless. So according to the market data we have, as of mid-January 2026, the market hit an all-time high of $310.4 billion.
That is a staggering amount of money sitting on blockchains. I mean, to put that in perspective, that's larger than the entire GDP of Finland.
Bigger than the economy of Portugal. It's huge. And when you break it down, it's not an even playing field at all. You have a clear heavyweight champ.
Which is Tether.
Tether, USDT. It's sitting at a market cap of over $187 billion.
$187 billion.
Yeah.
From just one company. That's just incredible dominance.
It's the juggernaut. Then you've got Circle's USDC in second place. That's around $76 billion. But we're also seeing new players climbing pretty fast.
Like Athena's USD.
Exactly. That one's climbed to about $6.4 billion.
And Athena's model is a bit different, right? It's not just we have $1 in a bank account for every coin.
Right. It's more complex. It uses hedging strategies, delta neutral hedging, specifically to hold its value. It's a different kind of beast than Tether or Circle, which are really just tokenized cash in a vault. So the giants are getting bigger, but the ecosystem is also getting more diverse.
But here's the thing that really stood out to me from that Tether report. We always just assumed stablecoins were for traders. You know, sell your Bitcoin, sit in Tether for an hour, buy back in.
High velocity, yeah.
But the data, it tells a completely different story now.
This was the big aha moment in the report for me, too. They analyzed all the wallets holding USDT. And get this, they found that 30.8% of these holders are what they call 100% savers.
100% savers. What does that mean in practice?
It means the money goes into the wallet and it never moves.
Wow.
They don't trade with it. They don't send it to an exchange. They don't buy anything. They just receive Tether and they hold it.
So for almost a third of the users, this isn't a trading tool at all. It's a savings account. It's like a digital mattress.
Precisely. And that's just the 100% category. If you look at general savers, people who keep most of what they get, the number is even higher. It really suggests that for millions of people, probably in places with unstable currencies.
Argentina, Turkey.
Yeah.
Places like that.
Exactly. This isn't about crypto speculation for them. It's about capital preservation. It's having dollars that your local bank can't touch and your government can't devalue overnight.
That completely flips the narrative. It's not casino chips anymore. It's global savings infrastructure. It's providing a service that, traditional banking just fails to deliver in those regions.
It is. If inflation in your country is at 100%, holding digital dollars isn't an investment. It's a survival strategy.
The survival strategy.
But of course, when you have $310 billion floating around, acting as a substitute for sovereign currencies, well, governments don't just sit back and watch.
They get involved. And 2025 was the year for that. We finally got some rules.
Yeah, for years, the industry was either begging for clarity or dreading a crackdown. Or both at the same time.
And what we got was the Genius Act.
Which I have to say might be the best acronym Congress has ever produced.
It really is. The Guiding and Establishing National Innovation for U.S. Stablecoins Act, signed by President Trump in July of 2025.
It was a watershed moment because before that, it was the Wild West. It was all based on, trust me, the money's there.
Right. Trust me, bro.
Exactly. The Genius Act laid down some really specific rules. The main one is pretty simple. Payment stablecoins have to be backed one-to-one.
By what?
By U.S. dollars or, and this is key, low-risk assets. So basically U.S. treasuries.
So no more shady commercial paper or weird corporate bonds. You have to prove you have the cash or something as good as cash.
That's it. And it created this new category of issuer, the PPSI, a permitted payment stablecoin issuer. You can't just be a tech startup in a garage anymore. You have to be a subsidiary of a bank or get a specific license.
But they did include that dual track system, right? I remember the debate was that the big banks were going to crush everyone.
That was the big fear, yeah. The dual track was a political compromise. It says if you're a massive issuer over $10 billion, you have to deal with the feds. You're in the big leagues.
Yeah.
But if you're smaller, under that $10 billion cap, you can be regulated at the state level. It creates a sort of incubation lane for smaller players.
So the little guys can innovate until they get big enough to matter.
Pretty much. But there's a huge geopolitical angle here that the Jones Day white paper really dug into. It's fascinating. They contrasted the U.S. approach with Europe's.
Right. Europe has MiCAR, which has been around a bit longer.
Yes, and MiCAR is very focused on consumer protection and what they call monetary sovereignty. They are very protective of the euro.
They don't want a digital dollar taking over.
Not at all. But the Jones Day paper argues the U.S. strategy is a form of crypto-mercantilism.
Crypto-mercantilism. Okay, let's unpack that. What does that mean in plain English?
Well, think about it. The U.S. government mandates that stablecoins be backed by U.S. dollars and treasuries.
Right.
So if the whole world, all those millions of savers we talked about, wants to hold digital dollars, then the companies issuing them, Tether, Circle, PayPal, they have to go out and buy U.S. treasury bills to back the coins.
So, wait. Every time someone in Vietnam buys 100 USDT to save up, Tether has to turn around and buy $100 of U.S. government debt.
Exactly. And the numbers on this are wild. The Tether report says that if Tether were a country, it would be the 18th largest holder of U.S. treasuries.
It would be ahead of Germany.
Ahead of Germany, ahead of Saudi Arabia.
That is mind-blowing. So the U.S. government basically realized, hey, if the world wants to stuff digital dollars under their mattresses, that helps us finance our own national debt.
It turns the entire crypto market into a massive built-in buyer for U.S. government bonds. It's soft power written into code.
So instead of fighting crypto, they just enlisted it.
In a way, yeah.
Okay, but let's not get too comfortable. Just because there are rules doesn't mean it's perfectly safe. We have this academic paper in the stack, the Systematization of Knowledge, or SOC paper.
The SOC paper, right, a real reality check.
They have this theory called stablecoin Legos. It sounds fun, but it's not.
No, it's not. This paper looked at over 150 studies and dozens of security incidents, and their main argument is that stability isn't. You know, it's not an inherent property. You don't just code value $1 and you're done.
So what is it then?
They call it an emergent fragile state.
Emergent and fragile. That does not inspire confidence for my life savings.
Well, it highlights this core tension in the design of these things. The paper calls it the dual mandate.
Which is?
You want stability, you want safety. But on the other hand, almost 60% of stablecoins also try to offer yield. They try to give you a profit just for holding them.
And that's always the trap, isn't it? Safe money doesn't pay high interest. If someone offers you 20% on a risk-free dollar, you should probably run.
That's it. The paper calls it high-risk financial engineering. You can't really have a rock-solid peg and high returns at the same time. So these researchers made a framework, the stablecoin Legos, where they map the design choices, the bricks of past failures.
Like Carolina back in 2022.
Exactly. They map those failures to current designs to see which ones are built on a shaky foundation.
I love that analogy. You're building a bank vault, but if you use the risky yield Lego brick, the whole thing could just collapse.
And speaking of things that make it collapse, a study from the European Central Bank, the ECB, had a really surprising finding on this.
Yeah, I saw this one. You'd think a big crypto crash is what would hurt stablecoins the most, right?
That's the common assumption. Bitcoin crashes, everyone panics, stablecoins depeg. But the ECB found that U.S. monetary policy actually hit stablecoins harder.
Harder than a crypto crash.
Way harder. Their data showed a crypto market crash drops the stablecoin market cap by about 4%. But a monetary policy shock, like the Fed raising interest rates, that drops it by 10%.
That feels backwards. Why would the Fed raising rates hurt stable coins?
It's the opportunity cost. Most stablecoins pay you zero yield, right?
Right.
If the Fed raises rates to, say, 5%, suddenly your boring old bank account pays 5%, a treasury bond pays 5%. Holding a digital dollar that pays nothing actually becomes expensive. You're losing out.
So money flows out of the crypto world and back into traditional finance to chase that better yield.
Precisely. It shows that at the end of the day, traditional finance still impacts crypto way more than crypto impacts traditional finance. These things are not in a vacuum.
Okay, so we've got the global savings accounts, we've got the government debt angle, we have the risks. But who is actually using this stuff, for everyday things? I'm not buying my coffee with Tether.
You might not be, but the creator economy is starting to. And this is where the PayPal story gets really interesting.
Ah, PYUSD, PayPal's stablecoin. They felt like a sleeping giant for a while there.
They were. But in December 2025, YouTube integrated PYUSD for creator payouts.
That feels huge. YouTube is everywhere.
It's a direct bridge from the creator economy to the blockchain. Think about a YouTuber in a country with hyperinflation or capital controls. Getting paid in their local currency is a losing game. But now, they can get paid directly in digital dollars.
And the growth numbers for PYUSD were just insane. What was it, like a 216% surge in supply in just 90 days?
Yeah, exponential adoption. And the tech behind it is really important. It's gone multi-chain. PYUSD isn't just on Ethereum. It's on Solana, on Arbitrum.
Which matters for payments because it makes it faster and cheaper.
So much cheaper. You can't send a creator a $50 tip if the network fee is $20. But on Solana, it's fractions of a cent.
And I saw something about PYUSD 0 and Layer 0. It sounded super technical, but why does it matter for a user?
It matters because it solves the wrapping problem. Normally, to move a coin between blockchains, you have to lock it in a digital vault on one chain and issue a sort of IOU on the other.
And those vaults, the bridges, are what get hacked all the time. They're a huge weak point.
The weakest link. This new standard lets the actual coin move between chains natively. No wrapping, no risky bridge. It's becoming seamless infrastructure.
So it's turning into plumbing. You don't see the pipes, you just turn on the faucet and value comes out.
That's it. The transition from crypto asset to fintech plumbing is the real story here. It's invisible, it's boring, and it's incredibly valuable.
But just to close the loop on safety one more time. The depegging nightmare. Are we past things like Terra Luna?
The Jones Day paper argues the regulatory environment is now much, much more hostile to those kinds of risky designs. Algorithmic stablecoins, the ones that rely on math instead of cash reserves.
The magic money.
The magic money is basically banned or heavily restricted under the new laws, like the Genius Act. If you can't show the cash, you can't play the game.
Got it.
And there's one more crucial consumer protection in the Genius Act. It says that stablecoin holders have priority if an issuer goes bankrupt.
So if the company fails, the people holding the coins get their money back first.
Before other creditors, yes. It flips the usual bankruptcy process. It treats you more like a bank depositor than an investor. It's a safety net that just wasn't there a couple of years ago.
It's acknowledging that people are using this to save, not to speculate. Okay, so let's try to sum this all up. We've gone from stablecoins being this, boring corner of crypto to a $310 billion global economy. We have private companies buying more U.S. debt than major countries.
We have laws like the Genius Act making it legitimate.
And we have YouTube creators in other countries getting paid in digital dollars. It's a complete maturation of the idea.
It really is. And if you zoom out, you can see stablecoins have really split into two main jobs now. On one side, you have the store value model. That's Tether.
The digital mattress. High savings, low velocity.
Right. And on the other side, you have the payment rail model. That's the PayPal and YouTube story. High velocity, everyday transactions, moving seamlessly.
It's like one is trying to be digital gold bars in a vault, and the other is trying to be Visa.
That's a perfect way to put it.
But before we go, there's one thought that's been nagging me since I read that ECB study.
The one about monetary policy.
Yeah. If the ECB is right, and U.S. monetary policy is the biggest thing that moves the stablecoin market, and if stablecoins are becoming the default banking system for all these other countries, are we not just accidentally creating a world where the U.S. Federal Reserve sets the interest rates for the entire planet, whether they like it or not?
That is a profound question.
I mean, if you live in a country where everyone uses Tether, You don't really care what your local central bank does anymore. You care what the Fed chair does in Washington, D.C.
It's like dollarization on steroids, completely bypassing local governments. We talk about crypto disrupting banks.
Yeah.
Maybe it's just reinforcing the dollar's grip on the world in a way we never saw coming.
Something to chew on. Thanks for taking the deep dive with us. I'll see you next time.